If the BRICS are selling US debt, why hasn't the dollar really fallen yet? And more importantly, if some players are leaving, who exactly is stepping in to replace them? Because US debt is not just a financial asset, it is the heart of the global financial system. It is where liquidity, trust, power, and politics intersect. And when money changes hands, power shifts with it, even if no one announces it out loud. The phrase that goes viral is simple and direct. The BRICS are selling treasuries. It generates fear, clicks, and the feeling that the system is on the verge of collapse. But the right question, the truly dangerous one, is different. Who is holding the bomb now? Because debt does not disappear. It always requires someone on the other side of the table. Here comes the first reality check. The latest data show that foreign holdings of U.S. Treasuries hit a record high in November 2025. At the same time, China reduced its position to the lowest level since 2008. That seems contradictory only at first glance, because this is not collapse. It is substitution. It is redistribution. And redistribution changes the risk profile of the system, even when total volume keeps growing. When you hear that the BRICS are selling treasuries, the mental image is of a coordinated move, almost a direct attack on the dollar, as if there were a single, organized strategy to bring down the U.S. system. But the real world does not operate like a conspiracy theory. It operates on flows, yields, risk, and opportunity. Each actor moves for a different reason. Selling can mean many things. It can mean reducing new purchases. It can mean shifting from long-term bonds to short-term ones. It can mean reallocating reserves into other assets. It can also mean simply letting bonds mature without reinvesting. And most importantly, selling does not mean the system collapses if another group is willing to buy. In November 2025, total foreign holdings of treasuries reached approximately $9.35 trillion, an all-time record. Meanwhile, China's position fell to around $682 billion. That number matters, but the signal matters even more than the absolute value. China is no longer expanding its bet the way it did in the past. While China was reducing exposure, others were increasing it. Canada sharply raised its holdings. Japan continued to add. The United Kingdom also increased its position. In other words, this is not a world abandoning the dollar. It is a world redistributing who finances the United States. Japan remains the largest holder of treasuries on the planet with more than $1 trillion, and this is critical to understanding the system's stability. Japan doesn't buy treasuries only for financial return. It buys for currency policy, macroeconomic stability, and reserve strategy. Japan needs a sufficiently strong dollar to keep its own economic structure functioning. The United Kingdom appears with elevated numbers, but here there is a technical detail that almost no one explains. London is a global financial hub and a major custodian. A significant portion of those treasuries does not actually belong to the UK. They simply pass through London. This distorts the picture for anyone looking at the data superficially. Canada, on the other hand, stands out because of its recent surge. It is not buying out of ideology or geopolitics. It is buying because the yield compensates and because, in moments of uncertainty, the dollar is still treated as a safe haven. Now comes a data point that completely changes the game, and that almost never makes the headlines. Between April and November 2025, European investors accounted for roughly 80% of foreign purchases of U.S. treasuries. This detail is decisive because European investors do not have the same long-term structural buyer profile that some Asian central banks had in the past. When you replace a structural buyer, one that buys with a decades-long strategy, with buyers that are more sensitive to market sentiment, the system continues to function, but it becomes more nervous. Money that entered out of fear can leave out of fear. The risk is not a slow, well-telegraphed collapse. The risk is a fast shock when sentiment flips. That is why the dollar remains strong, or at least resilient. Not because the world loves the United States, but because in moments of uncertainty the market still treats treasuries as the most liquid and safest asset available at global scale. And a resilient dollar does not need to surge to cause damage. It simply needs not to fall. It only needs to remain strong enough to pressure economies that depend on external capital, such as Brazil. When the dollar strengthens or holds firm, it puts pressure on fuel, shipping, fertilizers, industrial inputs, food, and energy. That translates into inflation that is harder to control.
And when inflation becomes more persistent, central banks lose room to cut interest rates. Higher rates for longer mean more expensive credit, heavier debt payments, less productive investment, and slower growth. That is how a decision made in Washington crosses the planet and hits the Brazilian consumer directly, even if the connection is not immediately obvious. Now we get to the most sensitive point. There are 3 triggers that can turn this fragile balance into real tension. The first is inflation and interest rates in the United States coming in higher than expected. If the market starts to believe that rates will stay high for longer, the yield demanded on treasuries rises. The second trigger is fiscal or political stress in Washington. No default is required, no formal rupture is necessary. Uncertainty is enough. A fight over the debt ceiling, the budget, or fiscal credibility is enough. Markets hate uncertainty more than bad numbers. The third trigger is global fear. War, tariffs, sanctions, geopolitical tensions, or any event that increases risk aversion. When fear appears, money moves, and it moves fast. When these triggers activate at the same time, the market demands a higher premium. Long-term yields rise. The 10-year Treasury spikes, and that number is the thermometer of global confidence. It is the price of trust over 10 years. When the 10-year Treasury rises, it becomes direct competition for every asset on the planet. The investor's question becomes simple. Why take political risk, currency risk, and liquidity risk in emerging markets if the safest asset in the world is paying more? That question turns into flows. Flows turn into exchange rates. Exchange rates turn into inflation. Inflation turns into monetary policy. And the cycle closes. The popular narrative says the BRICS are selling treasuries and the dollar will fall. The data show something else. Total foreign holdings hit a record while China reduced its position. This was not abandonment. It was redistribution. And redistribution changes everything, because it changes who sustains the system. And when the pillars of the system change, the system's behavior changes with them. The dollar remains strong because the world still needs dollar liquidity. But the quality of the buyer has changed, and quality matters more than quantity. Now comes the final warning. A system supported by committed, long-term buyers is more stable. A system supported by opportunistic buyers is more sensitive. It works, but it demands higher premiums. It demands higher interest rates. It demands constant confidence. And confidence is not a fixed variable. It is collective psychology. It changes fast, sometimes in days, sometimes in hours. That is why the risk is not waking up tomorrow to a collapsed system. The risk is living in a world of short relief windows followed by recurring tension, a world that is more expensive to finance growth, harder for emerging markets to breathe, and more volatile for anyone who is not protected. In the end, the question is not whether the dollar will disappear. The question is how much it costs to keep it dominant and who pays that bill while the game continues. Now I want to hear from you. Is this silent substitution of buyers real stability, or an illusion sustained by high premiums and fragile confidence?